produced one extra unit, the changes in the total cost. So to calculate that cost, we use marginal costing. Marginal cost formula is marginal cost is equals to changes in cost and changes in quantity. To calculate PV ratio, this results contribution into 100 divided by total sales. Total cost is equals to variable cost plus fixed cost. Hello everyone, I am Meghana from the Department of Commerce, lecturing in Vidhyaashram First Grade College, the Temple of Excellence. We are in the session 2 of Unit 3, Subject Accounting. In the last session, we have discussed about unit costing. In today's session, let us discuss with marginal costing. So what is marginal costing? Then formula of marginal costing and related to marginal costing. So let us begin with today's session, marginal costing. Marginal costing is used to calculate the changes in the cost when you are producing one more unit. That means the changes in the total cost to produce one more unit. So the marginal costing is the costing technique wherein the marginal cost, that is variable cost, is charged to unit of cost, while the fixed cost for the period is completely written off against the contribution. Here we have variable cost and fixed cost. Fixed cost is fixed for a period. Variable cost is changes depends on the situation. So here we need to calculate changes in the total cost when you produce one more unit or one extra unit. To produce one extra unit, the changes in the total cost. So to calculate that cost, we use marginal costing. Marginal costing is the changes in total cost when the quantity produced is incremented by 1. For example, if you are producing 10,000 units, means when it increases to 10,001 unit, the total cost, how much the cost is increased. The total cost which increased when number of unit produced increases by 1. It is the cost of production one more unit of a good. It can be explained through one simple problem. Here the variable cost per unit is 25 rupees. The fixed cost is 1 lakh rupees. So now if you are producing 10,000 unit means now you need to calculate the total cost. Total cost is equals to variable cost plus fixed cost. Here variable cost is 25 rupees. 25 per unit here. Variable cost is 25 per unit. So you are producing 10,000 unit. 25 into 10,000, that is 2,50,000. 2,50,000 is variable cost for the 10,000 unit. Here then fixed cost is fixed for the fixed period. Here to know the total cost, you need to add the fixed cost plus variable cost. Fixed cost is 1 lakh rupees. Variable cost is 2,50,000. Now the total cost is 3,50,000. Here 3,50,000 is the total cost to produce the 10,000 unit. If the total number of unit is increased by 1, that means 10,001. 10,001 to produce the 10,001 unit, how much the total cost incurred? To calculate that total cost of 10,001 units, you need to add fixed cost plus variable cost. Here fixed cost is 1 lakh. Variable cost will increase by 25 rupees. That means here to produce 10,000 unit, 10,000 into 25 is 2,50,000. So now it became 10,001. So 2,50,000, it became 2,50,000 25. 2,50,000 25. So 2,50,000 25 plus 1 lakh is 3,50,000 25 rupees. So what is the difference between the 10,000 and 10,001 unit? 3,50,000 25 minus 3,50,000. So the difference is 25 rupees. So this 25 is considered as marginal cost. The cost incurred to produce one extra unit or one more unit. So the term marginal cost implies additional cost involved in producing an extra unit of output. In this example, if the number of unit produced increased by 1 means we'll add 25 rupees only for the variable cost. Variable cost. But the fixed cost remain the same. Fixed cost is not affected by this changes. Why? Because fixed cost is fixed. It will not change by the number of unit. The number of changes in the number of unit, it will not affect to the fixed expenses or fixed cost. For example, rent. For factory rent, if you are manufacturing a product in a rented building means you need to pay rent regularly. If you are producing 10,000 unit also, you need to pay rent of rupees 10,000 or 50,000 per month. So, if you are producing 10,000 or 20,000, the rent amount is fixed. So, it will not affect by the production unit. So, that is fixed unit. So, fixed unit, it will not affected by the number of unit produced. Then variable cost means, variable cost, it depends on the production process. If you are producing 10,000 units, so then a variable cost is only for 10,000 units. If you are producing 20,000 means, the variable cost is also increases. A variable cost, an example is the cost of raw material. To produce the 10,000 unit, the cost of raw material, it may be 5,000. If we increase the number of unit produced from 10,000 to 20,000, the cost of raw material will also increase by 5,000 to 10,000. So, the variable cost is influenced by the number of unit produced or the total units. But fixed cost, it will not affected from the changes in the units. So, fixed cost will remain the same, but variable cost will changes. So, depend on the number of units, variable cost will change. So, it depends on the number of unit produced. So, the marginal cost implies additional cost involved in producing one extra unit of goods or producing an extra unit of output. Marginal costing or marginal cost equation. Marginal cost formula is marginal cost is equals to changes in cost and changes in quantity. To know the marginal cost, changes in total cost and changes in quantity. It can be explained through one simple problem. Just look at the problem. A manufacturing company has a current cost of production of 1000 pens at rupees 1 lakh and its future output expectation is 2000 pens with the future cost of production 1,25,000. So, the calculation of marginal cost will be 25. That means 1000 pen. 1000 is quantity produced. This is cost. Again, this is 2000 is quantity. 1,25,000 is cost. Marginal cost equation or marginal cost formula is changes in cost and divided by changes in quantity. Here, first changes in cost. First consider the cost 1 lakh and 1,25,000. So, 1,25,000 minus 1 lakh. Difference is 25,000. So, 25,000 is changes in cost. Then change in quantity. Quantity is 2000 minus 1000. Result is 1000. 1000 is change in quantity. So, marginal cost is change in cost divided by change in quantity. That means 25,000 divided by 1000. So, the marginal cost is 25. So, here change in total cost 1,25,000 minus 1 lakh, that is 25,000. Next, change in quantity 2000 minus 1000, that is 1000. Marginal cost is, 25,000 divided by 1000 is 25. 25 is marginal cost. So marginal cost is changes in the cost in producing one extra output. Next, under marginal costing, you have some formula to calculate contribution, selling price per unit minus variable cost per unit. Here variable cost means it depends on the number of unit produced. So selling price per unit minus variable cost is equals to contribution. Then PV ratio. To calculate PV ratio, this results contribution into 100 divided by total sales. Then BEP. BEP means break even point. Break even point is equals to fixed cost divided by contribution. Fixed cost is fixed. It is given in the problem. Then contribution. In order to calculate BEP, first you need to calculate contribution. Contribution is selling price per unit minus variable cost. Next, margin of safety. Margin of safety is equals to present sales minus break even sales. Present sales minus break even sales is equals to margin of safety, or else profit divided by PV ratio. Profit divided by PV ratio. If there is any information about the profit and PV ratio, we can use this formula to calculate margin of safety. Next, profit. To calculate profit, here sales minus variable cost minus fixed cost. So these all are some formulas. You need to remember this formula for the further calculation. So you have a problems on contribution, PV ratio, BEP, then margin of safety, all this formula. So remember this formula to calculate or to solve the problem. So mainly in the marginal cost, we calculate changes in cost to produce one extra unit. So this is the marginal cost equation or marginal cost formula. So this is an example of marginal costing. So here we can know to produce 10,000 unit, the total cost, and if we increase the number of unit by 1, the total cost is also increased. So the difference is considered as marginal cost. You need to remember all this formula. Next you have one more formula, number of units to be sold to earn desired profit. For that, total fixed cost plus desired profit divided by contribution per unit. So here they only given the desired profit. That means the company desired to earn this much of profit. They have given the amount desired profit in this case. So you need to calculate number of units to be sold. If you sold 10,000 units or 20,000 units, you can earn this much profit. So in this case, you need to calculate the number of units to be sold in order to earn the desired profit. Here fixed cost is fixed. You know the fixed cost is remain the same. For the contribution, selling price per unit minus variable cost. So from this you can get the number of unit to be sold. Next, sales value required to earn desired profit. Here we will calculate the number of unit to be sold. In this, sales value, selling price to earn desired profit. Same, the desired profit they only given in the question, and fixed cost it remains the same. Then PV ratio. PV ratio is equals to contribution into 100 divided by sales. Here you will use PV ratio instead of contribution. Here we calculate the sales value or selling price, but here number of units sold. Both the formula is to calculate the desired profit, but here you need to calculate the number of units sold, here the selling price. So you need to remember total. BEP means break even point. Fine. Both the number of unit and sales value is used to calculate the desired profit only. Including this 6 formulas. You need to remember 6 formula to calculate or to solve the further problem. This is all about today's session. Let us meet in the next session. Until then, keep watching. Thank you.